Hey everyone, Steve here from 11ish, a channel where we talk about lucrative but sound investment strategies and opportunities based on the requests from the 11ish collective. Today we're going to talk about 5 common mistakes all of us new or part-time investors have made before we conceded into building a real portfolio. Each of these points have serious consequences to how we make money and how fast and consistently we make money. And so if you're a new investor or you just make money very inconsistently, please check this video out so you can identify some of these mistakes and correct them before you lose your pants. If this is the type of content you've been looking for, please hit that like button and let's get started. The number one mistake I see from new investors is investing on buzzwords. Basically, they hear something from the news or they heard from their friends that they made a killing off of a ticker, and now you're having FOMO, right? You really want to go in on the stock because they made a shit ton of money. They're telling you this is a great company and you want to make a shit ton of money too. The problem with this kind of investing, especially if you're a casual investor, is that at least for the next 3 to 6 months, because you're a casual investor, the serious investors have already invested in this company. And therefore, the value has already been built into the price for the next 3 to 6 months. So there is actually a higher downside than upside in the short term. You're buying on the high at that point. You heard it because there was a high, and now you're looking at the stock, right? That does not necessarily mean it's a bad investment. It just means for the next 3 to 6 months, it's more likely for an adjustment for the stock price for it to go down than to go up. But if you're investing in a company with good fundamentals, it'll probably go up eventually anyway and make you money. But this leads me to the next mistake a lot of new and part-time investors make, and that is freaking the fuck out and impulse selling. You bought at a point where you don't fully understand the company, but you heard that this is a good company, and you put a shit ton of money into this thing, and next thing you know, the stock price is adjusting because you probably bought it a little bit too high and you're freaking out. Like, is the stock price gonna keep going down? You don't know, right? Because you didn't really go through all the research steps before you put the money in. I can't even describe to you how many times I've impulse sold even after I did my research. Now imagine you didn't do your research, you bought in, and now you're holding a bag that looks like it's going down, right? It looks way more dangerous, you're super stressed, and everything doesn't align in your head. And the next thing you know, as soon as you sell, the stocks start going up again, right? This has happened to every single one of us, I guarantee it. Ultimately, this is why it's a lot more important for you to invest in a stock where you believe in its business value and the product direction than the temporary, 1 week chart shape. If you invest this way, especially as a part-time, you'll feel a lot more comfortable on your investment because you know what the product is. This builds confidence in the type of investments you're making and also reduce the chances of you impulse selling. The third mistake a lot of new and part-time investors make is that their entire principle of investing is, how do I make a killing? How do I take everything and turn it into a shit ton more? And not being realistic is one of the biggest mistakes a new or part-time investor can make, because you're basically looking at the stock market from the outside. You hear about people making a killing and you think that's normal. I remember when I first started investing, I only had a couple $1,000s and I was trying to turn that into the down payment of a house within a year. But in fact, you'll soon realize that most investors, most good investors, all they're trying to do is beat S&P 500. And that's 10% return year over year. In fact, if you can actually beat the S&P 500, you have a very, very good chance of joining a hedge fund, making 6 digits, and managing millions of dollars. There's a reason for that. Because if you're aiming for moonshots, it's going to be inconsistent, unlikely, and there's only a few percentage of people who manage to do that, and most of the time, either they're insider traders, which is technically illegal, or they got super lucky. So the cure for this mistake is that you have to look at compounding your growth. If you look at making consistent gains of 3 to 5% per investment opportunity, you'll soon realize that you can make money way faster than you think. Just to put things into perspective, right? If your initial investment is $10,000, to make the numbers round, if you can make a 5% gain on every single stock you bet on 10 times in 1 year, you'll be able to turn 10 grand into $16,000 because you're compounding it, 5% and then 5% again and then 5% again. With that $16,000, In the next year, if you can do that again 10 times, you'll be able to turn $16,000 into almost $30,000. In 2 years, you'll be able to triple your money. If that is the growth strategy that you're going after, it's way more realistic than making one bet and trying to make it grow 5x. And in order for you to do that, you gotta stop playing penny stocks. This leads to the next mistake that most new and part-time investors make, and that is choosing penny stocks. Stocks that are less than, let's say, $5. Now, if you're doing it for fun, it's different, right? I play with some of my money and I bet with really cheap stocks for fun. In fact, I've actually invested in a stock where each share is worth a third of a penny. I owned 1 million shares just so I can tell my friends I own 1 million shares. Of course, there is an upside, but I realize that it's probably harder to make that grow than winning the lottery. I was fully aware of that, but relatively speaking, it wasn't that much money, and ultimately I can pull my money out without losing, let's say, too much, as long as I'm staying on top of it. That's why I invest in it. But if that is your investment strategy overall, then you're aiming to get hurt. The mentality of a new or part-time investor is that you think that if a stock is worth $1, it's a lot more likely for it to become $5. Therefore, you 5x your investment. But as we talked about in the previous point, you're risking a lot more, and the chance of it becoming 5x is actually a lot lower than you think, because there's a reason why the stock is cheap. Whereas if you invest in a company like Microsoft or Google or Amazon, or even like the $100 range, it's a lot more likely for a company that has good financials, and you choosing the right market during the right time in history, it's a lot more likely for that to grow 3 to 5% and play the compound game so that you can consistently make money and minimize your risk instead. And the last mistake most new and part-time investors make is relying too much on what your friends think and what professionals think. That is a good starting point. I mean, otherwise I wouldn't have started this YouTube channel, right? Because ultimately I'm here to help, like most investors out there. We're putting us out there because we want to help the community. We want us all to make money. There's enough money for all of us to make some, right? But the thing is, you have to do your due diligence, because how we invest might not match how you invest. When I say a stock is good, it also takes into account how I look at bankroll management in my own context, in the industries that I'm familiar with, and et cetera, the type of research I do. All of these are very, very important. So it's really important for you as well to figure out what is your criteria for a good investment, how you manage bankroll, how you look at investments in general, and what is the growth that you seek. All of these things come together in order for you to figure out what your portfolio should look like. So these are the top 5 mistakes that I see time and time again from new and part-time investors. Sometimes I still make these mistakes. But c'est la vie, this is why it's fun to invest as well. It's part of the learning process, it's a mental challenge, and in the end, we're all here to make some money, and that's also fun. If you're new to the 11ers Collective, this is exactly what we do. We share strategies and opportunities. We talk about tips of how to consistently make money, and then we make money together. Thanks for watching. I hope you found this video entertaining and helpful. If you know someone who needs a reality check, please share this video out. We're trying to grow this community and also improve everyone's financial literacy. If you have any questions or concerns or requests for what you want me to talk about next, please leave a comment so we can open a dialogue, and I look forward to working with you next time. Thanks for watching.